Hey everyone, and welcome to today's Explainer. Look, if you're a new retail investor just stepping into this space, or even if you've been around the block a few times, the crypto market right now can feel absolutely overwhelming. But that's exactly why we're here. We are cutting straight through the noise, ignoring the Twitter hype, and tearing apart the actual on-chain data to give you an absolute edge. I am so thrilled to be guiding you through this today because right now, we are looking at a total global crypto market cap actively stabilizing at exactly $2.18 trillion. Yeah, trillion with a T. But beneath that massive top-line number, there is this incredibly complex battle playing out. It's a tug-of-war between retail panic, institutional accumulation, and shifting macroeconomic tides. So today, as we unpack this market strategy for you, we are leaving the emotional narratives right at the door. We're going to rely purely on what the data, the order books, and the undeniable on-chain metrics are screaming at us. Get your notes ready because we have a ton of ground to cover to make sure you are fully equipped for the week ahead. Okay, let's dive into this and map out our visual roadmap for today's complex market report. First, we'll check the macro market pulse. Second, we're looking at the Bitcoin versus Ethereum reality. Third, our forward-looking asset watch list. Fourth, decoding the MVRV indicator. And finally, number 5, we'll wrap up with community Q&A and altcoins.
Section 1, the macro market pulse. Let's set the stage.
To really understand the crypto tape right now, we have to step all the way back and look at the broader macroeconomic stage. Over this past weekend, the market experienced a massive, decisive shift. We saw a huge injection of risk appetite. The bears had their golden opportunity to break the $60,000 floor on Bitcoin, and honestly, they failed miserably. Capital is actively rotating back into risk assets, and if you are sitting entirely on the sidelines right now, the data strongly suggests you might be systematically losing out to inflation and opportunity cost. But what exactly sparked this weekend rally? Well, that brings us to a really critical metric, 48.9. This is the preliminary print for the U.S. University of Michigan Sentiment Index. Now, you might be wondering, why does consumer sentiment matter for my crypto portfolio? Well, a low consumer sentiment print like 48.9 often signals to institutional investors that inflation fears are finally cooling down, and that gives those big institutional bulls the exact excuse they need to start aggressively bidding up risk assets like crypto. When you combine this macroeconomic backdrop with the renewed geopolitical optimism we saw surrounding Iran over the weekend, you get this incredibly powerful, somewhat unpredictable catalyst that drives capital straight back into the markets.
Section 2, Bitcoin versus Ethereum reality. So now that we've established that the overarching sentiment shift for this week is a decisive bullish reversal, we need to shift our focus from the broad macro environment right down to the individual heavyweight assets. We want to see exactly how this renewed sentiment is affecting the actual trading tape, and frankly, the divergence between the two biggest players in the space is staggering. Zooming in on Bitcoin, we tracked an absolutely massive $18.07 billion in 24-hour volume. Let me be super clear about this. This isn't just retail noise or some random weekend chop. This is aggressive, systemic buying. The price was heavily suppressed earlier in the week, but weekend liquidity traps basically forced late shorters to cover their positions, which resulted in this violent rebound above the $64,419 mark. Bitcoin is literally dominating the tape. But now, look over at Ethereum. It is a completely different story. Ethereum is currently trading at $1,679, but it is struggling so heavily with fragmented liquidity. That means trades are inefficient, they're scattered across different platforms, and it's basically just clinging to support rather than leading the charge. And the reason for this struggle? It points to a much deeper structural reality in the market right now.
Which brings us to this terrifying metric and a major reality check. Tether, USDT, has seen its market cap swell to an unbelievable $186.5 billion. That is astronomical. And it creates a stark contrast for Ethereum. The fundamental question the data is forcing us to ask ourselves is this. Is the stablecoin plumbing actively eating the network's value proposition? Utility on the blockchain is exploding, yes, for sure, but it appears to be entirely bypassing Ethereum's base layer token. While everyday retail traders are obsessing over Bitcoin's daily up and down chop, Tether's massive size is actively threatening the fundamental value proposition of Ethereum itself. We might literally be pricing in a completely new structural reality here.
And this brings us to a foundational lesson, especially for those of you aiming to protect your personal investment capital. This comes directly from a strategic Bitcoin long position the report reviewed, which secured a really clean 3.2% unleveraged gain earlier this week. The core lesson here is simple, yet incredibly profound. Trust the volume, not the narrative. Look, if your trading system is driven by emotion instead of raw data and liquidity heat maps, you are absolutely going to get chopped up in this environment. Think about it. When the news out of the Middle East was terrifying and the narrative was overwhelmingly bearish, the actual on-chain data told a completely different story. You have to let the metrics dictate your risk, not the dramatic headlines.
So, let's break down the technicals behind that data-driven win. What did the metrics actually show us? Analysts monitored the exchange order books and spotted a massive cluster of limit buy orders resting just below $63,700. Think of this like a giant safety net deliberately placed to catch falling prices. This was a textbook liquidity sweep. Once the price dropped into that zone, whale wallets instantly absorbed the retail panic selling. Basically, they let retail traders sell the bottom based entirely on fear, while they systematically accumulated those coins at a massive discount. We rode their coattails on the bounce. The data showed whales accumulating, plain and simple. No emotion, just execution.
Let's move to and see how this builds. Section 3. Forward-looking asset watch list.
All right, let's pivot from past trade reviews directly into our actionable alpha watch list. This is where we outline high-probability setups and the precise structural zones you need to be monitoring for the week ahead. Here are the specific assets and levels on absolute priority radar. First up is Hyperliquid, ticker HYPE. It's currently trading around $60.47, and it just printed a massive 24-hour volume spike of $549 million. This decentralized exchange protocol is actively absorbing serious market share from legacy platforms. Next is Solana, sitting at $68.91. With nearly $1.6 billion in 24-hour volume, its network activity is absolutely skyrocketing right now. While Ethereum is struggling with its narrative, Solana is just continuing to validate its speed and efficiency thesis, showing incredible relative strength against the rest of the market. And finally, for Bitcoin, the exact structural zones are laid out for you. That $63,700 support base we talked about, that is the absolute floor. If we lose that level, the bullish thesis is invalidated. On the upside, immediate heavy resistance sits at the psychological $65,000 barrier. That is the immediate battleground we're watching.
Now, identifying the battleground is only half the job, right? Executing safely is the other half. As an absolutely crucial strategy for any retail investor, the report emphasizes that we do not trade on hope. We trade on systematic triggers. Think of this as your core risk and security checklist for the week. For a new Bitcoin long entry, the exact condition is waiting for a confirmed 4-hour candle close above that $65,000 resistance, and you must verify accompanying volume. Actually, let me reiterate that. Do not try to front-run the breakout. Wait for the absolute confirmation. Once triggered, you must manage your risk aggressively by setting a tight stop-loss right below the breakout candle. This systematic, emotionless approach is exactly how you protect your personal investment capital from unnecessary losses.
Section 4. Decoding the MVRV indicator. Moving forward, let's elevate your trading IQ with our Systems Masterclass segment. We are going to focus entirely on what is widely considered the single most important on-chain anchor in the entire crypto market. It's an indicator that cuts right through the daily volatility to show you the fundamental health of the network. Now, what's really interesting about this slide is the math behind MVRV. It's brilliantly simple once you break it down. We are demystifying the MVRV ratio, which stands for market value to realized value. To get this number, you just take the total dollar value of Bitcoin at today's current price, and you divide it by the value of all Bitcoin priced at the exact level each coin last moved on the blockchain.
So, why does this specific mathematical formula matter so much to us? Well, because it gives you the network's true cost basis. It tells us not what the market is momentarily pricing the asset at due to fleeting speculation, but what the actual participants fundamentally paid for their positions. This is, hands down, the ultimate tool to identify whether the market is structurally overextended or fundamentally undervalued. It takes the guesswork completely out of the equation.
The way we use this systematically is by monitoring two distinct zones. The top zone, the overvalued territory, triggers when the ratio pushes above 3.7. The bottom zone, the undervalued territory, triggers when the ratio drops below 1.0. When it drops below 1.0, it means the average coin in the network is effectively underwater, and historically speaking, that signals a generational bottoming opportunity. So where are we today? Right now, we are sitting well within the median range. This means the market is fundamentally healthy. It's not over-leveraged to the upside, and it's not in capitulation mode either. We use this healthy median reading systematically to size our macro spot bags appropriately without letting FOMO take over.
Section 5. Community Q&A in altcoins.
For our final section today, we are going to wrap things up by stepping away from the purely macro indicators and taking a look at specific chart requests submitted by the community, based entirely on the source data. First up, we have a viewer chart request for Dogecoin, or Doge. Looking at the data, Doge is currently sitting right at 9 cents, carrying a $13.5 billion market cap. Structurally speaking, if you look at the daily time frame, it shows it is holding higher lows, which is definitely a positive sign. However, we really have to remember how market mechanics work
especially if you're managing a newer portfolio. If risk-on sentiment continues to flood the market, retail capital typically rotates into Dogecoins last. It's the tail end of the cycle. So the report's strategy here is crystal clear. Keep it on a secondary watch list for potential late-cycle rotation, but hold off on allocating any core capital just yet. Be patient.
Finally, we have an incredibly pertinent question from user Crypto Nomad in our Telegram channel. They ask, with Tether hitting 186.5 billion, is it too big to fail? Wow. It's a question that honestly haunts the underlying mechanics of this entire industry. The harsh analytical reality is that Tether is deeply and perhaps irreversibly integrated into global dollar settlement. It is literally the lifeblood of crypto liquidity right now. If it ever depegs, we face immediate, systemic contagion across every single asset we've discussed today. For now, its dominance remains completely unquestioned. But it really forces us to step back and ask, are we building a decentralized future on top of a centralized, single point of failure? It's a reality we must constantly monitor. Stay sharp, trade smart, trust the volume, and manage your risk. We'll see you in the next explainer.